Hundreds of thousands of researchers around the world are working to improve life and address imminent threats to humanity. Often their research ends up in the scientific valley of death in the form of publications and patents that never see the light of day. That is about to change. Welcome to the Lab to Startup podcast, hosted by Naresh Sunkara, founder and executive director of the Berkeley Postdoc Entrepreneurship Program at the University of California, Berkeley. This show has two main goals: share the stories of those who have successfully founded startups based on their own research, and highlight resources needed to help those aspiring to launch startups in the deep tech space. Whether it's electric cars, vaccines, addressing climate change concerns, or possibly establishing life on other planets, Naresh and his esteemed guests want to help scientists, engineers, faculty, and researchers bring their innovations to market. Learn more and subscribe today at labtostartup.com. And now, here's Naresh.
My guest today is Sandy Kory, who is a managing director and co-founder of Horizon Partners, an M&A firm working with bootstrapped companies. Sandy is also a general partner of a new seed-stage venture capital fund, HorizonVC. Sandy has been advising bootstrap technology companies for over 15 years and co-leads client engagement there. He previously invested in technology startups such as Palantir, Canva, and Zoox that went on to become unicorns. M&A is something that I am very new to and decided to make this episode of Lab to Startup as an M&A 101 class for startups. I came across Sandy in a Twitter post on the subject of choosing an M&A firm by a mutual friend, Leo Polowitz, who is a general partner at Zoox Ventures. I followed up on Twitter, and Sandy kindly agreed to come on as a guest on the podcast and talk about M&A for bootstrap companies. So let's jump into this conversation. Sandy, welcome to the show, and congratulations on the recent announcement of a new seed stage venture fund. While you put on multiple hats at Horizon, I would like to start our conversation by talking about M&A side of the business. It would be helpful for our audience if you can give a thumbnail sketch about Horizon Partners and what you mean by high-touch artisanal M&A model.
Sure. And thanks for having me, Naresh. It's a pleasure to be on the podcast. So for Horizon Partners, the focus is on working with bootstrapped technology businesses. The approach that we developed over time was really to take a long-term approach, getting to know founders, often over many years, before engaging with them to advise on transactions. And so it's a bit counterintuitive because M&A is obviously a transactions-driven industry. Generally, in M&A, the economic incentives are around closing deals and getting a fee when a deal closes. And so a lot of people in our industry are very focused on, hey, let's get a deal done. It's always a good time to get a deal done. Real estate agents might be kind of similar. It's always a good time to buy or sell a house.
Yeah.
Good for me because it gets me a commission. But for us, we think that trust might actually be the most important thing, building a trusted relationship with a founder, with a client, because you don't want the client to suspect your motives. And so we find that taking a long-term approach to getting to know founders is the best way to build trust over time. And the bootstrap technology businesses that we work with are generally good businesses, and they don't have to do a deal. And so you could try to persuade these founders to sell, but it's not necessarily the right thing for them. And so in my M&A career, I think it's kind of an odd approach that I've taken. I've never wanted to persuade anyone to do a deal. It's always been about, if you want to do a deal, here's how to go about it. Here's how to get the best outcome that you can. And so that's kind of been our approach with Horizon Partners, particularly focusing on the niche of bootstrap technology businesses.
Thank you for that. As you mentioned, the M&A for exceptional bootstrap technology companies. From my understanding of startups, like you mentioned, most startups are not actively thinking about M&A while they're bootstrapping. Why did you decide to go behind that model? I asked this question because most of my podcast has been focusing on deep tech startups, and inadvertently, they end up being merged or acquired at some point, but we don't think about it early on. How should one think about it, and what was the thesis behind going after this model for you?
So I wish it was all intentional. You kind of look back at your career and maybe you connect the dots, but it wasn't always so deliberate. And so I kind of personally stumbled into tech investment banking in 2004. I wanted to be in the tech industry in the Bay Area, but I couldn't code. And M&A advisory for technology companies was a way to be in the technology industry. And then I joined a firm that happened to have a niche on working with bootstrap businesses. And they were kind of generalist, but I really wanted to work with technology companies particularly software companies. And so kind of found that niche there. And then fast forwarding a few years in 2010, with my partner, Mike Firmage, we started Horizon Partners. And we had both worked together at another firm working with bootstrappers. And we really enjoyed getting to know these super scrappy, super gritty folks. And also what we found with bootstrap technology companies is in some areas, they are overdeveloped because if you're bootstrapping, you have to have revenue and profit versus a lot of tech startups where the model is to not have revenue or profit for some time. But they all often were underdeveloped in some areas, like, for example, finance and accounting. If you raise $20 million from VCs, you're going to need to have a very tight financial model accounting for every penny. But if you are the only owner of a business and you're, say, 30% profit, which is great, you might actually not have a really tight financial model. I mean, it might not really matter to you if you're actually at 26% profit or 30% profit, or what's your cash flow. All these things might not really matter much to your business. But if you want to sell your business, it's quite important. Buyers need to know that deals can't get done without high resolution on financials, accounting, things like that. So that's an example of where bootstrap companies are kind of underdeveloped. And we really liked, my partner Mike and I, we really liked being more hands-on, working with fewer clients as opposed to higher throughput, more clients. We liked working with fewer clients and being very hands-on. And so we really liked working with bootstrappers because that model really fit well. And then we also found that working with clients, sometimes over a few years, was pretty unusual. Again, in the industry, it's pretty transactional. And then I didn't mention before, artisanal. What does that mean? Every deal, I think, when done perfectly, which is tried to do, is going to be done differently. And sometimes things can be very complex. And so we've had, for example, multiple transactions where there were actually two buyers or two investors. So usually if you're selling a business, one buyer, but sometimes it actually makes sense to have multiple parties. And so particularly with my partner, Mike, who kind of spearheads execution, and he is just as good as it gets with deal making, there's a lot of complexity that most M&A firms don't really gravitate towards, but we really do. And so that's kind of how we think about this artisanal approach. But it really comes down to more concentrated, fewer deals, fewer clients. If you're doing it like us, you better be good at closing deals, because if you don't close deals, you're not going to have a business. So, knock on wood, but we've been pretty good at kind of only working with a few clients at a time, but having a very high close rate.
Yeah, I've seen all the awards you've been winning. Congratulations on all those things. There's so many threads we can go after, but let's go to the basics. There are two parties involved in the M&A. One is usually the startup you're talking about, and another one, generally a bigger company. I want this to be a 101 for M&A for startups. So when and how should startups approach the subject of M&A?
Yeah, so I would even go a little bit more high level to negotiations. And negotiations is one of those things that lots of people think they're an expert in negotiations, but then you might say, okay, what's your approach? What's your strategy? What do you do? And then people might say, I don't really know. And so there's a great book that I always recommend. It's kind of a very quick read, but a nice handbook for negotiations that does provide a great strategic framework. It's called Getting to Yes, bestseller, a lot of people read. And so I'll kind of summarize some of the framework for Getting to Yes, where if you're going to negotiate anything, mostly keep in mind three ideas: interests, options, and criteria. And so criteria is kind of like what's fair. And there's always subjective ways to define fair. But if you want to sell anything, part of the negotiation between a buyer and seller is like, what's fair? And so what criteria should we use? If you're selling a house or company, comparable transactions is always a good source. And so ideally, you're going to have some objective criteria that you agree to. Although whether you're a seller or a buyer, you have some influence over what is the criteria that we use to evaluate what's fair. So criteria is really important to keep in mind. And keep in mind, if someone is trying to push you into criteria that you're not comfortable with, talking about criteria that you think is more fair. But saying, I want this, that's not criteria. Criteria is based on evidence. And so criteria, interests is very important. And so often in negotiations, we get stuck on positions. I'll give you $600. No, $500, $600, $500. You kind of go back and forth. But really, you want to understand the underlying interests. An example in M&A is often sellers or buyers will kind of have a valuation in mind. And a seller might say, I want to sell for $10 million. And maybe a buyer says, no way, I'm going to give you $10 million for that business. Well, let's dig a little deeper. The underlying interest for $10 million, if you're the seller, do you need the $10 million all when the deal closes? Maybe you'll take some over time. And if you say to the buyer, hey, you don't want to pay $10 million up front, but maybe $10 million over 3 years isn't so bad. And so if M&A, when it's valuations reported in the headlines, often it's, hey, $1 billion valuation or $100 million valuation. But the underlying deal structure is very important. And those are examples of like how you can use interests to find like the win-win. But probably the most important factor, I think, for negotiations for M&A is options. If you're trying to negotiate and you're kind of at a standstill, thinking of options, and some of these negotiations aren't business, they're personal. Like, what restaurant should we go to tonight? Let's come up with some options, Italian, Mexican, and so forth. So M&A, to kind of get back to your question, if we're talking to startups, so you want to sell your business, keep in mind options. Because unfortunately, if you have no choice but to sell your business, well, you've got a very, very weak hand in negotiating. And buyers generally will perceive this. You might try to mislead buyers and say, oh, I've got all these options, but that pretty much never works. And this is kind of a rookie mistake that maybe over-eager sellers might make, is they might say, oh, our business is doing so well, we've got all these options. And then a buyer might say, sure, okay, let's do a deal. And you might even agree at a high level to a deal structure, valuation, things like that. But then to close a deal, you're going to go through due diligence. And a buyer will, you can assume, know everything about the business by the time it's done. And so if there's some things that you have held back, like you're about to run out of money or if someone's suing you, that will be revealed. And so if you don't have options, generally that's going to be a problem. And so the best strategy in M&A, or if you want to sell, is to have options. Now, what can that mean? Now, multiple buyers is great. If you're talking about M&A firms, advisory firms, what the heck do they do? Well, a big piece of their value add is they will work with a seller to find as many buyers as possible. And so they'll reach out and they'll try to maximize competition, because that maximizes leverage, which can help to maximize the best possible deal. But ahead of that, if you're a startup, often it's you have to raise money. And so if you're trying to sell when you have very little cash and you have a high burn, that's dangerous. That's going to be a tough one to pull. Sometimes it happens. Sometimes with M&A, sometimes wild things happen. But unfortunately, I wouldn't expect miracles. So if you want to sell your business, I might say, why? Let's get back to the interests that you have. And you might say, well, I don't really want to sell the business, but I'm running out of money. So I have to sell the business. And so, well, unfortunately, buyers are probably going to see that you're running out of money. And so that's going to be a challenge. So what you need to do is get someone to fund your business. Then you might not want to sell your business anymore, which is fine. But like having those options. And so if you're a seller and you're a startup, you have to be careful about burning relationships with investors. But if you have VCs willing to fund you, oh, these VCs are willing to give me 10 million, 20 million, what have you, that gives you leverage with buyers where you have some options. And so that's a much better way to approach M&A. Sometimes people think that M&A can be engineered like sales, and that's false. And so for startups, selling, you really want to hustle. You want to show your work. You can be very persistent. And if you're trying to partner with a big pharma company or any big technology company, being persistent, saying, hey, I really want to work with you. This is going to be really important. Like, what's going to take for me to work with you? You're trying to get Google to partner with you. Like, what's it going to take? I really want to do it. That's a good approach. Like, people will respond to that. Partners will respond to that, and they won't hold it against you. On the other hand, if you're trying to sell, that is going to spook the buyer. If you're like, hey, I really want to sell, like, what's it going to take? They're going to say, oof, you're a sinking ship. You don't have any option. So there's a funny contrast there where signaling. And so if you're selling in terms of sales and business development and partnerships, you can try hard and use that to your advantage. That can help win over customers and partners. But if you're trying to sell your business, no. And in fact, I would kind of recommend playing hard to get. If someone knocks on your door interested as a buyer and you want to get them to pay the most, well, don't open the door the first time. Tell them that you're not interested in selling and then see if they come back. Because if they don't come back, they were probably just looking for a bargain. But if they come back and say, oh, yeah, well, we're really interested, then you have a buyer with a real interest that you might be able to use to an attractive transaction.
Sandy, thank you for that framework. Interests, options, and criteria seem to be great pointers to think about. We will have a link to that book reference in our show notes. Well, let's double click on the subject of signaling. What have we learned over the years about signaling, and what are some of the best forms of it that you've seen?
Yeah, so with signaling, like the major risk in M&A for a seller is to seem over eager. And sometimes it might be accidental. I mean, sometimes you might not need to sell, but you're just an extremely friendly person. But that still can create a signal where it might be perceived that you're eager to sell. And every buyer is going to be very sensitive to these signals. And put yourself into the shoes of a buyer. You have some interest in a target. You're thinking a lot about how much you're going to have to pay. Maybe you're the VP of Corp Dev, you run M&A at a big company. Maybe the CEO says, we got to buy them. I don't care the price. But you want to get the lowest price you can. And generally, of course, it's not like that. Generally, part of your consideration as a buyer is finding a reasonable price. So you're going to be very sensitive to these signals. You're going to be kind of hoping that the seller is pretty eager to sell because that means you can pay less. And so back to the negotiations framework of interests, options, and criteria, like you're an online video business and you're like, hey, Google bought YouTube for $1 billion. Like that's criteria. But ultimately, like I think with buyers and sellers, there's kind of a game theory, real world dynamic that dominates the negotiations. And so if you want to get the buyer to pay $100 million, you probably need to find someone else who's going to pay $95 million. Or maybe there's a VC who will give you that valuation. So it's really that kind of game theory dynamic that I think is really important. And so kind of back to signaling. And look, I mean, there's other signaling advice to buyers, but that's, we're really focusing on being sellers. And so some people naturally express more confidence than other people. You could be extremely confident, but not actually express it. That's certainly a personality type. But if you're dealing with buyers, you want to express that confidence. You want buyers to think that you're optimistic about your long-term potential. You want a buyer to think that you have high conviction in your mission, in your vision. Hopefully you do. And I would never advise anyone to be dishonest because it's the wrong thing to do. Morality aside, it's also a poor strategy because it's not going to last. Buyers are going to see through things. And so you want buyers to think that you're really high conviction in what you're doing. If you are really high conviction in the potential of what you're doing, you're not going to be in a hurry to open the door if a buyer is knocking. Or if a buyer says, so first conversation, hey, Naresh, why don't you go ahead and just send me all your financial data for the past 3 years? That'll help us understand what's going on. And so if you think that you've got the next Google on your hands or the next Moderna on your hands, you're not going to be in a hurry to send over financial information. Like, whoa, what are you talking about, man? Like, I'm not doing that. On the other hand, if you really want to sell and a buyer says, hey, do these things, or better example, frankly, is meeting with lots of people. And so if I'm a buyer and I'm interested in you, I'm always going to say, now meet someone else. And so a good buyer is going to have a process that they're going to kind of insert you into, and they're going to use all your time. It might be legitimate. They might have a lot of people on their side that want to talk to you. But if you keep on saying yes, and you're meeting the VP of this and this VP of that, and the CIO, and you're signaling you're overly available, and a buyer will perceive that. And by the way, it can also be very distracting to a seller. And so it's a common case where a seller's business underperforms after they engage in discussions with buyers because it can be distracting. The time can have a real impact, and also the psychology. All of a sudden, if you're daydreaming about selling, you might not quite be executing in the same way as you were previously.
Yeah, I've seen a lot of those cases. What are the most common mistakes the startups make while approaching buyers?
Yeah, so I'm not a big fan of approaching buyers.
When approached, let me reframe that. Yeah,
the signaling. So I would say being overly motivated to have conversations, whether you're super interested in selling or not. I think that signaling that's probably the biggest mistake. But also, so then we can kind of take that a little further. Yeah, it's a bit like dating, okay? And so if you have a lot of confidence in the value that you bring to the table, you might be pretty picky about the partner. If you're really insecure and don't think you have much value, then you might just say yes to anything. Not trying to give anyone dating advice, but I would say we should be choosy, all right? And we shouldn't hesitate to ask some questions. You want to know about people. So if you're talking to a buyer, you can qualify them. Now they're going to ask you questions and kind of qualify you, and that's part of the conversation. But you should be able to ask them questions about why are they interested in speaking with you. You can ask about their M&A experience. So one common thing is a buyer is knocking on the door. Are they serious? Are they just the type of person that talks to everyone on the street? Is there actually signal here? And same goes for investors in the sense that there are some investment firms that reach out to everyone. And you might want to have the conversation. that investment analyst that talks to lots of companies might have some good insights for you, but don't be confused to think that is like serious interest. There's kind of a funnel, in sales and a funnel in M&A as well. And so know when you're top of the funnel. And so back to the question, biggest mistake. A big mistake is not realizing you're in the top of the funnel, not the bottom of the funnel. And this can be the same for VC conversations. Generally, the VC conversations move a little bit more quickly. Sometimes a buyer might only be talking to you if you're making, purple tables, but maybe they're talking to the 10 other companies that also make purple tables. Maybe they're talking to the companies that make pink tables or purple sofas. And you also need to be sensitive to relationship building. So you don't want to be a jerk and ask questions that might rub people the wrong way, but you can ask about so sounds like you're interested in purple tables. Can you tell me more about that? Oh, have you talked to other companies making purple tables? Oh, interesting. What type of purple table maker would be the best fit for you? And so you want to ask those questions to learn about the motivations of the buyers and also understand kind of where you are in the funnel. And then also sometimes buyers don't actually have capability to do a deal. And you don't want to spend a lot of time with a buyer. And it turns out that, they want to buy you, but they just need to raise $100 million. Well, wait a second, that might be pretty risky. So qualifying a buyer, I would say, is an area also where it can be, I don't want to be overly critical because these are hard things. And great founders probably don't have much experience in M&A. So it's not to say, this is some big mistake, but this is just an area where there's kind of specialized experience. And various people can give advice to founders on this. You don't have to be an M&A firm to have good knowledge here. But I would say signaling is a major mistake. Not knowing where you are in the funnel is a second mistake. And then properly qualifying the buyer is a third mistake. And those are probably three of the big ones. And then maybe the fourth one to add is also being sensitive to the relationship. And so you want to ask some tough questions, but you don't want to alienate the other party. Just probably like if you're on a date. You don't want to know a bit about who you're dating, but you also want to ask questions in a friendly way that's strengthening a relationship, not weakening it.
That's a nice segue into talking about what should a startup do if somebody knocks at the door, a buyer comes to them. Should they first come to a M&A firm like yourself? Or maybe we'll take a different look about that. Like, how do you evaluate a startup that approaches you to help with an M&A? How do you view their technology risk versus market risk? And what are the factors you take into consideration before you take a client or a startup?
Yeah, definitely. So let me give you a little bit of a broader answer, because I think the best founders are going to talk to investors, assuming they want to raise money, and they ideally will understand, kind of quickly build a mental model of what motivates investors. What are their interests? The investors, they have their interests. And so understanding that. And then similarly with buyers. Now, with buyers, it's often more complicated, especially with big company buyers, because there's lots of stakeholders and different people have different interests. But you want to kind of understand that. And again, sometimes you're talking to an investor or a buyer who maybe they're actually interested in someone else and they're just talking with you to check the box. So you want to try to understand their interests as well as you can. And economic interest is a great place to start. Like, how do you make money, or what's in it for you? But there's other interests as well, of course. Now, for M&A businesses, economic interests are going to be pretty important. And so generally an M&A firm will look at a startup or any prospective client, and they'll think about the economic potential. Same, I think, for a law firm or an accounting firm or other professional service businesses. And so some firms are more focused than others. For Horizon Partners, our focus has been bootstrapped technology businesses, mostly SaaS or software-driven businesses. Other firms are generalists. Sometimes there's regional firms. We work with companies in Seattle. That's regional firm focus. And so there might be some level of segmentation if you're an M&A firm, or, hey, we only want to work with this type of business. And so is this a fit for us or not? But then the economics are usually going to be, what is the fee potential here? M&A businesses are kind of boom or bust, because if a deal doesn't close, generally you're not making much money. There might be a retainer involved, but generally that's a pretty small piece of your revenue. And so the deal fee is if a deal closes. Now, if you're talking to Goldman Sachs, they might say, hey, our minimum fee is $10 million, and we only want to work with deals that are going to be $15 or $20 million. So then if you're Goldman Sachs, you think typically we charge 1% or 5%. And so, okay, is this a $1 billion deal? Because we need to charge 1% or 2% and make our economics work. So that's how M&A firms will be thinking. And so certainly they're going to want to get to know you. And usually for most firms, I would say life is short in that you don't want to work with people that you don't really get along with. But I think if you're thinking about talking to M&A firms, keep in mind that their economic interests are going to be pretty important. And if they look at you and they think, there's actually no way that a buyer is going to pay much for you, then they're not likely to want to spend a lot of time with you. But at the same time, for us, and I think for good M&A firms, they take a long-term view. And so having an introductory conversation is often just fine. Maybe that leads to something more serious, maybe not, depending on the actual deal potential and the fee potential of that engagement.
What does long-term mean for you? Maybe you can take an example that you're very fond of that you worked with, and how long are we talking? And what was that relation building and execution look like?
Sure. Early in my career, I cold called a business called xe.com. It's a website that you probably have run into at some point. It's a website and a mobile app with foreign currency exchange information. Great bootstrap business, xe.com. They started business in 1994. You want a 2-letter domain name, just get a time machine and go back in time. And I cold called the business in 2005 and built a relationship with the founder over many years. At a certain point, I kind of transitioned to another firm and kind of lost touch with the founder, started a firm with my partner, Mike, and we had a guy working for us who was really talented, and he noticed the company and was like, oh, yeah, we should be talking to those guys. And so he reached out and we kind of reconnected with XE. And I believe we then engaged with them in, I want to say 2014. And then we worked with them for maybe about a year or so to help them get ready for a transaction, then closed a deal in 2015. So it was a 10-year sales cycle, if you want to think of it like that. That's pretty common. So we'll get to know companies over, that's maybe extreme, but we like to get to know companies over a couple of years to really get to know them. In our M&A business, we're very focused. We work on fewer deals. I think if you work on a lot of deals, the cost of failure is lower. So if you're more concentrated, you have to be a little bit more careful. And so for our M&A business, it's that approach. And I think the best way to be careful is to kind of get to know people over time.
What was the toughest negotiation you had to have so far? And if you compare an easier one, are there things that you did right in the easier one and what went wrong or what made it tough in the tougher one?
Yeah, well, every deal is really quite different, especially in our model, which is pretty concentrated. And so we advised a bootstrapped technology business selling to the music industry. And my partner did an amazing job of negotiating a transaction that involved both a private equity firm and a major strategic player in the music industry. Now, that business was doing very well. And so getting some buyers and investors to the table wasn't that hard. And probably any M&A firm could have done a decent job there. Where we really, I think, excelled was with this very creative deal approach where we had to get a giant strategic company in the music space and a kind of a venture capital private equity firm to basically participate in the same deal. It's kind of cats and dogs living together. It's uneasy. And so that was a very complicated negotiation. And for the founder, like in the music industry, he really wanted to bring on an investor that specialized in growth as this business was growing very fast. At the same time, the music industry is one where the founder would say, it's one of these industries where it is pretty important to know the right people. There's these powerful record labels, there's these powerful online music companies. And so that was a very tough negotiation where we were able to get this major household name music technology company and a really good kind of investor in the same deal. At the same time, probably the really hardest ones, because hardest is often very stressful, is when you don't have a lot of options. And so I'm not going to give you all the details, but there have been a few deals that we've done where there was just one buyer and no plan B. So that's a hard negotiation because you want to get the best possible deal, but you don't have much leverage. And so I think ideally you have lots of options, and the job of the M&A advisory firm or any negotiator is just a lot easier when there's a lot of options. And so you might say, hey, I negotiated this amazing valuation for this seller. It's great. You did a good job, but Microsoft and Google and Amazon were all competing. And so maybe it wasn't that hard. Whereas if you have just one buyer and you still get a really good deal done. So another way to frame it is kind of like, what's the gap between the high bid and the second bid? And if there's a big gap from the first bid to the next bid, that's pretty impressive because it means you're able to get someone to really step up and make a really compelling deal, even though the seller didn't have much leverage. So we've had some of those.
Thanks for that plugin. And a related topic that came up during a call last week is how not to learn from past deals. Sometimes you do the right things, but then it'll end up in a bad result. And sometimes you make mistakes and give you a great outcome. What can we learn and what should we not learn? More on that.
Yeah, it's a great question because there definitely are some. The main thing is be suspicious of the headlines because the headlines can be deceiving. And the second thing is that the best exits are really outliers and kind of by definition, not generalizable. And so one of the great exits in recent times in technology was WhatsApp selling to Facebook. And I was not involved in that transaction. I was able to read a fair amount about it, public stuff. It happened very quickly. And Mark Zuckerberg was very involved. I think WhatsApp did a good job. They got a high price. That was an exceptional dynamic. So if you're going to sell to Facebook, make sure Mark Zuckerberg is like really obsessed with the deal. Sure. But that's probably, they buy a lot of companies. And I don't think Zuckerberg is that involved in all these deals. Picking on Facebook deals. They bought Oculus, great exit. I'm not sure there's much to generalize there. Sometimes you'll hear people say, oh, it's really important to have relationships with the buyer. And it doesn't hurt. But I would say often that relationship is only something that happens like after the fact. Now, I could be wrong here, but I'm pretty sure the WhatsApp founders didn't have any relationship with Facebook. I don't think there's any personal chemistry. And then the flip side is for all the companies so it's kind of like, okay, so if you have a good relationship with a buyer, that might make you 5% more likely to get a deal done. But is it really worth the time versus all the other things? Because by the way, the most valuable thing you can do is to make your business really successful. So if the WhatsApp founders had spent a lot of time cultivating relationships with Facebook and Google, I don't think they would have been anywhere near as successful. So I do hear this advice from people saying, oh, really important to have relationships with buyers. And I would just say, I don't think that's a good place to spend time. If you happen to be seated on an airplane next to the CEO of a Fortune 500 company, great, build that relationship. But I think it's the wrong thing because then the message sometimes is like, oh, I can use relationships and get people really interested. And it's true that you can get meetings that way. If it was as simple as just, oh, I'm going to get a meeting with someone in the dev department and a buyer, but that does not yield a deal. That just generates a meeting. So really the best thing to do if you want to sell your company is to make your business valuable. Don't run out of money. And so, relationships are part of that. But I think it's a kind of a fool's gold piece of advice to say, oh, you need to have these relationships with buyers.
Speaking of relationships, I'm guessing your business is mostly depends on those relationships. If you're trying to convince a startup to work with, how do you showcase or how do you build those relations differently from a startup founder?
So I think in the M&A industry, M&A advisors, I think they kind of oversell their relationships. Now, I only started in 2004, so 18 years. In the 1980s, basically before the internet, I think those relationships were probably really important. Like back then, knowing people's phone number. How did you get the phone number of the buyer? I don't know. How did you do anything for the internet? I don't know. But in today's age, you can get in front of the buyers for the investors if you have a decent business. Now, if if you're going out of business or you don't have much, but buyers generally have a corp dev team. If you're a small company and you want to buy, maybe it's a person, but buyers have people and it's their job to see deals. So they will meet with you. It's not that hard to get in front of these people. I think that it is valuable to really understand the interests of the buyers, but it's not about, playing golf with them. And frankly, sometimes if you're playing golf with them, who are you more interested in serving? The CEO of some big company that you're friends with or a little company that's selling? And so I think the value of those relationships is pretty oversold. I think if someone is very thoughtful about the motivations of a buyer or an investor, that's really valuable. But you don't really need to be golfing buddies or close friends to have those insights. So I think that's kind of oversold. And then the flip side is that there's more value in helping the companies be well positioned to attract more buyers. Because sure, if you're a golfing buddy with some CEO, they'll take your call. But if the business is a dog and it's not good, that's not the way. Maybe business used to work like that. Again, I don't really know exactly how business was done in the 70s. But in this day and age, no one's going to bail out your business because the M&A firm is friends with the buyer.
Good to know that. Let's slightly shift gears into maybe a lower level of M&A. If a startup wants to acquire or merge with another startup because they have a complementary technology, have you worked with such cases and what are the best practices in that?
Yeah, it certainly happens all the time. It depends on the industry. there's a bunch of different levels there. I mean, so one thing in that type of deal is there might not be much cash involved. And so if you're a seller and you're going to sell your business to another startup in return for their stock, you should probably be careful about the value of that stock. However, Google has arguably been the most successful acquirer in tech history. I mean, there's a few other great acquirers, but Google, so many great businesses, YouTube and DoubleClick and so forth. One of their great early acquisitions was Applied Semantics. And that was the technology that basically facilitated like the AdSense business, like contextual advertising. And they bought Applied Semantics pre-IPO. And it was an all-stock deal. Pre-IPO, Google, people didn't really know quite how good a business Google was. And so that was an all-stock deal with a startup where one startup sold to another startup. And it worked out really well. The Applied Semantics founders had extremely lucrative exits with Google stock. So it can work out. The other thing is, if you're a startup, if you're a seller and anyone is interested in buying you, have they done deals before? And so if there's a startup that wants to buy you and they've never done any deals before, do they have the capability? Do they know what they're doing? Because their eyes might be bigger than their stomach. And so just making sure that they have some trusted advisors who can help them, I think that's pretty important, because you can spin your wheels a lot if you're kind of naive about what you actually need to do to get a deal done. So that kind of goes back to like the buyer qualification that any seller would want to do. But absolutely, startups can buy each other or merge. There's lots of ways for them to combine, and there's lots of examples where that's worked out well.
Yeah. How do you pick an M&A firm? If there's a checklist of things that founders should look into, what would the top 3 or 4 be on your list?
I think I gave some advice to a friend, Leo Polovets. We tweeted that's probably got some good thoughts. If you want an M&A firm, there's a bunch of different dimensions. You want to find a firm that is going to care a lot about your deal. You probably don't want to be the biggest deal that a firm is working on, but you probably don't want to be the smallest. So figuring out like the sweet spot for that firm. Do they typically do deal sizes of 200 million and up? Well, if you're a $100 million deal, they might not give you the time of day. If they typically do deal sizes of 10 to 20 million, if you're a $100 million deal, maybe that's a little bit more than they're capable of. So that's one element. I do think that getting to know people over time is the best way. It's tricky because there's only so many hours in a day. But ideally, if you're talking to an M&A firm about working with them and engaging with them, it's not a let's have one conversation and decide. Ideally, you talk to them 6 months ago to get to know them. And ideally, if you talk to an M&A firm, you're thinking, hey, I'm going to do a deal next year. I think talking to a couple of different firms right now makes sense. Get to know them. I think if they're pushing you to do a deal more quickly than you want, I think that's a bad sign. You kind of want someone who really is going to have your back and be aligned with you. See if they offer to help. And then if they do that, I think that's a good sign. I mean, when we get to know companies over time, we try to be helpful. And then ideally, if we are talking to a seller about working with them, we can say, look, hire the firm that's been most helpful. So I think that's a good framework. Hire the firm that, we kind of say the same thing if you're talking to investors. Work with the investor who's been most helpful. So I think those are some answers that are probably a little different than the ones from the tweet, but I want to try to give some incremental thoughts.
Thank you for that advice. And let's slightly shift gears and talk about HorizonVC. Please talk about the fund, the areas you invest, and the check sizes.
Yeah, absolutely. So this is a seed stage venture fund primarily focused on bottoms-up and product-led software businesses. To take a step back, I started angel investing early in my career and was fortunate to make some angel investments in many different types of great businesses. Now, Palantir Technologies, a great enterprise software business. Well, actually, they sold mostly to the government in the early days. Very much like a sales-led, traditional top-down software business. I invested in a seed round in Canva, which is a great bottoms-up software business. I was fortunate to invest in some great biotech companies. Billion to One is an awesome diagnostics company. I'm in some great consumer companies. At the same time, I did over 100 angel investments, and plenty of them did not work out. And often you learn more from those than the ones that do work out. But I found that I had kind of the most success and the most impact as a value-added investor with these bottoms-up software companies, these kind of product-led software companies. And so that's really where the firm is focused. We ideally are what I would call a first check investor. And so these days, maybe that's like a pre-seed round. It's a little, all over the place with the language between seed stage, seed, pre-seed, mango seed, post-seed. So we're not super caught up on that, but we do like to be as early as possible when we invest. And thus far, we've done checks between 300,000 and $1 million. We'll probably do checks a little bit bigger than that and maybe a little smaller than 300,000, but that's kind of the typical range for us.
What got you started? excited about Palantir back in the day. I think relatively first investor, one of the first investors in there.
I wish I could say I was one of the first investors, but I wasn't. I was an early investor in early 2009. And it's funny because at the time I didn't know anything about angel investing. I think accidentally used what I do think is the best approach. But at the time I didn't have the perspective to know that. But really the story was that I was good friends with a guy who has basically become like the COO of the business. And I went to grad school with him and he was just amazing. And I think if we had done a survey in this graduate program, I think he would have been voted most likely to succeed. And he joined Palantir as, I think, like employee number 13. I remember when he joined, he was just in awe of the founders and early employees at Palantir. So, they were amazing. And this guy was amazing. So it's kind of like you went to school with LeBron James, and LeBron James is saying, these guys are so good at basketball. It's amazing. Like, wow, that must be an amazing group of basketball players. And so in this case with Palantir, it was early 2009, middle of the financial crisis. I mean, banks were going down. The world was in a really chaotic place. I genuinely thought that it was like a safe investment. I knew there was some risk, but I thought it was a pretty safe investment because these guys seemed to be the smartest people on the planet, at least the smartest people I ever knew. And they were definitely making progress. I don't even know if they knew what exactly they were doing. I mean, it was a big data analytics. It was very complicated business to explain. And I didn't really know much about what they were doing, but I knew the talent there was kind of off the charts. So that was the investment. And then I started Horizon Partners with my partner in 2010. A couple of years passed where I didn't really have any income. So I didn't do much angel investing. But fortunately, we had some good outcomes with Horizon Partners. Started to do some angel investing in 2012, 2013. I was a little bit more experimental as an angel investor. And there's some great investors who invest on traction. There's some great investors who invest on markets. There's great investors who have different approaches. But in hindsight, the approach that I am most attracted to is finding the best founders. Of course, how do you do that is hard. You know, in my grad program, like there was only one person who was like this, most likely to succeed. So it's hard to find these people. Sometimes if you're talking to a founder, you only have like one conversation and then you have to decide. Boy, that's a hard thing to do, to kind of decide if someone's so amazing. I suppose if I had a 10-minute conversation with Elon Musk, I would know enough to know he's an amazing founder, right?
What do you look for in a founder?
And I think about this all the time. So I could go on and on and on about it, but probably not worth getting into here. Certain markets, I think, are more deterministic in success. And so I think if we take the best founders and put them in consumer social, it's kind of a lottery. The best founders in therapeutics and a lot of deep tech is kind of a lottery. I do think that B2B software is the most deterministic and bottoms up even more so. The easy one to forget is determination and just people who just don't give up. Sometimes there's someone who's done that in a million things in their life and it's obvious. But other times they might have gotten crappy grades or they might have dropped out of this or quit that. But maybe for this startup, it's kind of their calling and they have that amazing determination. So where do you find the signal for this determination? But that's definitely a really important signal. I think that intelligence is obviously really important, although you don't necessarily need to be the smartest person, but you need to be intelligent. But even more importantly is just learning. Like some of the most brilliant people that I ever met in terms of, I don't know, test scores and things like that weren't always the fastest learners. So really there's a term that I like a lot for founders. And I would say it's to be a learning machine. Doesn't necessarily mean you test it off the charts. I think because there's like humility, because you have to admit when you're wrong, but there's confidence to have the conviction to pursue a goal that might be a little crazy. So learning machines to people who are just intensely curious, want to learn, confident, but also kind of humble and constantly learning. So that I think is the best kind of type of founder. But I got to tell you, it's not easy and I could be wrong. So I'm also trying to learn myself as I go along.
Yeah, learning machines, that's something I look for if I'm trying to hire somebody. You can really go wrong if they're trying to learn something. I got another question from Leo. Apparently, you've been investing a lot in Australia and Africa actively and before most of the people in the world. What made you decide to do that and how do you get comfortable investing in those areas?
Yeah, well, so early in my career, I did a lot of research looking for bootstrapped technology businesses. And I was curious enough to notice that there were great bootstrap technology businesses off the beaten path outside of Silicon Valley. Like early on in my career, I did some great work in Canada, not that far from the US, but some Americans maybe 15, 20 years ago wouldn't have realized that Canada had some amazing companies. I talked to Shopify when it was like $1 million in revenue and didn't get a chance to work with them or invest in them. And I remember Atlassian was this really interesting looking software business, bootstrapped out of Australia. Later on, I met a guy named Nicky Shavak, really fortunate to meet him when he was in the Bay Area. He moved to Australia in 2000, moved back to Australia in like 2011, I think, and really tried to basically modernize the Australian tech scene with some other awesome people I worked with. And so I was able to invest in his fund called Blackbird Ventures. And that was amazing because it helped me get access to some great companies like Canva and meet a lot of amazing people. So kind of just serendipitous relationships with Australia. And then with Africa, one of my best friends moved to Africa and ended up living there for 4 years and opened my eyes to just opportunities there. And that a lot of times there's capital starved markets, but there's lots of opportunity. So then the first time I saw an African startup, a company called Olu, 2015, I think, maybe I was kind of primed to think that there was real opportunity there. And so I invested. And as an angel investor, I would be a little bit experimental, maybe with like smaller checks. And then actually Leo, who's just an amazing investor and has made some great introductions for me, introduced me to a guy named Greg Roxon of M Pharma, I believe in 2016. And he was just amazing, like one of the best founders on the planet. And so it's less about investing in Africa and more about investing in the best founders on the planet. I do find it really exciting to invest in different areas. And I do love when there's a nice social impact. But ultimately, for me, it's about the best founders. And with some good luck, I've gotten to meet some great founders in Australia and in Africa. I wish I knew the great founders in other, Lord knows, Latin America, India, Southeast Asia, they're everywhere. But for me, it's really been the US, Africa, and Australia, where I've just been fortunate to build relationships with great founders. And then great investors often will follow when you do get to meet those founders.
That is great. That's great. I think that network really helps. One last question before we go. Now that you're a VC and also you handle M&A activities, is there a conflict of interest? What prevents you from pushing a startup to go and merge with something else because there's incentives there?
Well, I'm glad you asked the question. And so today in the M&A business, I'm really part-time. My partner, Mike, is the kind of front man. And so I'm maybe a few hours a week in M&A, although I'm always happy to kind of be helpful with our clients or with other companies. But really, the answer is, boy, I am glad that Canva never sold. I don't know if Canva had many offers to sell. They raised money publicly at a $40 billion valuation. They probably could have sold. I don't know. They probably could have sold for $1 billion or $2 billion. And so what I've learned with early stage VC is it's about getting in the great companies and proverbially letting the winners run. So I don't want those companies to sell. And I don't do IPOs. Maybe if I did IPOs, it's really about finding these great founders, being supportive. And then what does happen, kind of sadly, but it's part of the ecosystem, is that sometimes startups aren't successful. They have to sell. And then often they will ask me for advice. And it's frankly, you could say it's like a money-losing endeavor because I don't make any money on that. I spend a lot of time on this, but I do want to help. I get to meet these great founders who are putting so much into these businesses. And if it happens that they do need to pursue M&A without a lot of options, I am there to help. But that's definitely not something that's going to help me economically.
Sandy, thank you so much. I didn't want to put on the spotlight or anything. I just want that clarification for my audience as well.
I appreciate it. No, it's always been something that people have said, oh, you're an M&A. But then it's like, no. I invested in Palantir and Canva. They're not looking for my M&A. I hope I can help them in other ways. So that's really where my passion is. But I am also happy to help if people do have questions on M&A.
Yeah. Great. Thank you so much. This has been a learning experience for me. I never knew anything about M&A. I learned a lot of this is 101 startup for me for M&A. Thank you for all the lessons and good luck with the VC firm and all the mergers and acquisitions.
Well, thank you, Naresh. I really enjoyed it. Yeah, hopefully it was helpful to you and the audience. I really appreciate the opportunity.
Thank you for listening to this episode of the Lab to Startup podcast. You can find links to the resources and programs mentioned in these episodes, connect with Naresh, or subscribe to this show at labtostartup.com.